Timing in life is everything. And when it comes to investing, developing the best timing to finalize tax planning can determine how much money you're going to have to pay. If you're a real estate investor like me, then you know that depending on when a property is sold, it can generate huge profits along with large capital gains. In this video, we're going to highlight the top 5 tax deferral strategies that you can use whenever you're selling property. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist that wants to get you out of the rat race by saving you from the tax man. Download the Passive Income Guide to get started today. Now, let's first start off with a very quick review of exactly what is involved with whenever you're selling something. More importantly, what exactly is a capital gain tax? All right. So actually a capital gain occurs when you actually sell an asset, okay, for more than you paid for it. So here's the formula. Capital gain is you take the selling price and you subtract it from what you paid for it. Not only does the government want a cut of your income, it also wants to tax you on the profits that you make from your investments. And that cut, my friend, is the capital gains tax. According to the IRS, almost everything that you own and use for personal or investment purposes are called capital assets. Examples include your home, personal use items like household furnishings, stocks and bonds held as investments. You have a capital gain if you sell the asset, again, for more than your adjusted basis. You have capital losses if you sell the asset for less than your adjusted basis. By the way, any losses from the sale of personal use property, such as your home or car, they aren't tax deductible. So think about it. The IRS, they take from you when you win, yet they kick you when you down and when you lose. Good stuff, right? So the amount that you're taxed if you have a capital gain, it depends on basically how long you held the asset before selling, which leads us into the next thing. Short-term capital gain tax. Now, any gains that you make from selling assets that you've actually held for less than a year, these are called short-term capital gains. And typically they're taxed at the same rate as your ordinary income. This is going to be anywhere from 10 to 37%. On the other hand, there's a long-term capital gains tax. So long-term capital gains tax are based on any profits received from a sale of an asset that you've held for more than a year. And depending on your taxable income rate and your filing status, the long-term capital gains rate is going to be anywhere from 0 to 20%. It's going to be much less than a short-term capital gain. So, which leads us into, which is the first way of the 5 ways that you can defer capital gains taxes whenever you're selling real estate, is based on this right here. You want to at least wait a year before you sell, because again, you're going to pay a long-term capital gains tax. You're not going to pay the short-term capital gains tax, okay? By using this strategy, you're going to reduce your federal capital gains tax burden dramatically, especially if you have a larger capital gain. Number 2, you want to use the primary residence exclusion. Now, one of the questions people have involves paying taxes on the sale of their home. Typically, selling a home, it really doesn't affect your taxes, as even if there's a profit, it can often be excluded. This is something called a home sales exclusion. Let me explain. According to the IRS, if you have a capital gain from the sale of your primary home, you may qualify to exclude up to $250,000 of that gain from your income, or up to $500,000 of that gain, depending on how you file. If you file single, $250,000. If you file married filing jointly, up to $500,000. Now, to qualify for this exclusion, you must meet both the ownership test and use test. Now, you're eligible for the exclusion, okay? You're eligible for the exclusion if you've owned and used your home as your main home for a period aggregating at least 2 out of the last 5 years prior to its date of sale. You can meet the ownership and use tests during different 2-year periods. However, you must meet both tests. You must meet both tests during the 5-year period ending on the date of the sale. So generally, you're not eligible for the exclusion if you excluded the gain from the sale of another home during the 2-year period prior to the sale of your home. Third way is probably one of the most popular ways, and you've probably heard about this, is the 1031 exchange. Now, this is actually defined under Section 1031 of the IRS code. This deduction strategy allows an investor to defer paying capital gains tax on investment property simply when it's sold. The catch is that another like-kind property must be purchased with the profit gained by the sale of the first property, following a strict timeline that you must follow. So let's take a look at the different steps. First one is you must exchange or sell a property, investment property, for another. Remember, it's got to be like kind. It must be real estate for real estate. Second, the property replacing the original property, it must be of equal or greater value. Third, you must follow this timeline we talked about. You have two main things in a timeline, two main timelines. The first one is you're going to have 45 days after you sell your property to identify up to 3 other properties. Okay. Now, this can be done in writing, but you have to purchase at least one of the 3. All right. The second timeline is you actually have 180 days to close on one or more of the 3 properties that you identified. Next, you must use some sort of 1031 intermediary to help, which basically means that all the funds, okay, so all the funds, it must go through this neutral party. And after agreeing on a sales price, this intermediary, they must wire the capital gains basically to the title or the holder company. And then they'll fill out the appropriate IRS forms, that sort of thing. Fourth way is something called a DST, or a deferred sales trust. Okay. This is just another method that you can be used to defer capital gains. So for example, if you're selling a property, okay, typically you would receive the sales proceeds whenever it closes. Now, by using this DST, these proceeds are placed into the trust. Okay. So you have basically you sell the property and the proceeds are put into this trust. Okay. And they're only taxed as the funds from the sale are received. So this allows you to reinvest from the sale into investment vehicles that aren't allowed by other capital gains tax deferral strategies. Now, Internal Revenue Code 453 is a tax law that prevents a taxpayer from having to pay taxes on money they haven't yet been received on an installment sale. This is where the DST comes in. The process basically works, again, by selling the asset. You're selling the asset or property to the trust. And this is used with an installment sale. Next, the trust sells the asset. The trust sells the asset to the buyer, and the funds are placed in the trust without having to pay taxes on the capital gains. Okay? Buyer to the trust, don't have to pay taxes. The trust doesn't have to pay taxes because it sold the real estate asset for the same amount it paid for it with an installment sales contract. Okay, so if you're the seller, because you haven't physically received funds from the sale, you don't pay any capital gains taxes yet. Now, with this setup, instead of the buyer paying you in one lump sum at the time of the sale, the buyer actually agrees to pay you over multiple future installments, hence the term installment sale, which it can start instantly or it can be deferred for several years. You determine that. So the third party trustee, they're the ones that can basically invest the funds however you like. You can earn interest income on the money from the sale while it sits in the trust. So while the money sits here, you can actually earn interest income on that money from the sale while it's in that trust, and only begin to have to pay capital gains taxes when you start receiving principal payments. And last but not least is something called, and it's a really hot topic right now, opportunity zones, investing in opportunity zones. Okay, this is another way that you can defer capital gains tax if you invest in a qualified opportunity zone. Now, in 2017, the Tax Cuts and Jobs Act was basically passed by Congress. It created this program which encourages real estate investors to basically put their money in low income areas in the U.S. And by doing this, they're going to offer you significant tax benefits. Capital gains tax on a property sale can be deferred by investing in called QOZ, Qualified Opportunity Zone. So capital gains tax when you sell a property can be deferred by investing in one of these through a Qualified Opportunity Fund, a QOF. So QOZ, Qualified Opportunity Zone, through a qualified fund or QOF. The deferral is in effect until the investment is sold or exchanged on or by December 31st, 2026, whichever one comes first. So similar to the 1031 exchange timeline, the QOZ investment program must also meet certain requirements. So basically, within 180 days of the sale of the property, the capital gains must be invested and needs to be exchanged for equity interest and not debt interest. So the time period in which the investment is held, it actually determines the amount of tax benefit received. So for example, if the investment is actually held for at least 5 years, the basis of the investment, it actually increases by 10% of the deferred gain. All right. If the investment is held for at least 7 years, the basis of the investment increases by an additional 5% of the deferred gain. And then for 10 years, if it's held for 10 years, the basis can basically be adjusted to the fair market value on the date it's sold or exchanged. Now, too many people, when you talk about money and investing, too many people are focused on offense, always focused on running the ball, passing the ball, scoring a touchdown, hence making more money, when many times they should be focused more on defense, keeping the money that they have, not losing any more money, not getting other people to score on you, hence not losing money, hence not paying more taxes. Real estate investors, the good thing about real estate investors, they can easily save thousands of dollars on capital gains taxes by using just a few of these strategies that we talked about in this video. Make sure that you speak with a qualified tax advisor to give you the best advice. Depending on your situation, you may be able to use one or more than these. Now, if you want to learn more about some of the tax loopholes the rich use to pay zero tax, check out my interview with Robert Kiyosaki's personal CPA, Tom Wheelwright, where he breaks down some of the unique ways that you can achieve this. You can check this interview out over here. Take care.